Cloud. All right, for someone seeing the recording, I started, we're only a few problems in, but I forgot to hit record at the outset, so something would be better than nothing. All right, so then let me share this with Brendan Linehan. You're up next, then we'll go to Maggie. I gotta make sure I don't put the exam on. I think that's it, right? Yeah. All right. All right, Brendan Linehan, what do you got here? Did I just lose you again? No, he's there. You're on mute. But this is your question, Brendan Linehan.
Oh,
Okay.
sorry, what was that? I left the Zoom because I couldn't hear anything. I just came right back.
Okay, 4-79.
Yep.
Did you do this one yet?
Oh, I was looking over it yesterday. Yeah, I ended up getting 148,200, but I did not write down how. I just made like, yeah.
So let's see.
Hold on, look at it again.
It's sort of the same idea as a couple problems ago. So let's start with the non-control. Let's determine that with the beginning so we're trying to identify the non-controlling interest at December 31, 2020. It happened at the beginning of 2019, so they're going to have 2 years of activity. But what was the if we stop, what was the non-controlling interest at the date of acquisition? How would you get that, Brendan?
I did 500,000 divided by 0.8 to get the total value, which was, 625,000.
Right. So therefore, the non-controlling interest would be what at that date?
125.
Right. I agree with that. So I'll put beginning I'll call it NCI, non-controlling interest. All right. 125. Then what?
Hold on. I do not remember how I did this.
Yeah.
I remember I went through this with Adam, but I didn't really get the chance to like do it in depth.
All right. Actually, so I think Caroline did this. I think this is just an extension of the problem a couple problems ago. So I'll do it. So Caroline said for 2020, you got they make $100,000. The non-controlling interest is entitled to 20% of that, right? So that's 20,000. And that's the income. And Brendan, if they pay dividends of 40, how much it pertains to the non-controlling interest?
So you would do 40,000 times the remaining 20%. So
Right.
40 times 0.2 is 8,000.
Right.
Which reduces the
Yep.
account.
And then we had the excess amortization. We had the up above, we said buildings were undervalued by 30 and excuse me, equipment was undervalued by 30 and buildings were undervalued by 40. So that's, and they made it easy by having both have a 10-year life. So there's a 70,000 to step up that we had to amortize. That's $7,000 a year. How much does that pertains to the non-controlling interest?
You have to multiply that by 0.2. So 7 times 0.2 is
Yeah.
1.4 thousand.
Yeah, so we'll do 1.4. So that's where it stopped. But this one just continues a little bit and it goes on. You need another year's worth. So you have to sort of do the same thing. So what would be next for 2000 as we move forward to 2020, Brendan?
So you do 120,000 times 0.2.
Yeah.
And you get 24, which you're going to add.
Yeah.
Then you're gonna do the dividends, which is 50,000, multiply that by 0.2 again, and you get 10,000, which you're gonna subtract. And then you have another year of amortization, so you're just gonna subtract another 1.4.
Right, so the dividends of what? Dividends were
Dividends were
50,
10,000,
so it's 10, right?
yeah.
And then the amortization, it's the same number, nothing changed.
Mhm. That's how you get your 148, 2,000, or
Yeah.
200.
Yes. So everyone see that? That's just reinforcing what Caroline did correctly a couple problems ago, but just by adding a year onto it. All right, that's not too brutal. Any questions on that one? Hang on, let's see. All right. Did you guys go over question 28? Let's see.
We did not go over that.
I was unable to copy it out of the ebook. There must be some copyright issue. Let's see what it was. It's the same concept. I might come back to that if we have time. I'll leave that open, but I'll keep going just to keep it moving along. Maggie, what do you think of this chapter 6 question 663?
Let me get to it. All of the above, 1, 2, 3, and 4.
Let's see here. Yes, that is correct. So the role of the equity investors can be minor, right? Because we said that one of the reasons you use the variable interest model is when the risks and rewards don't flow and correlate to the amount of equity someone has in, right? VA may be specifically created to benefit a business enterprise that established low-cost financing. Yes. Usually limits activities and decision-making because it's usually for a specific purpose. So 3 and 4. So those are all correct. Let's see, Evelyn. How about 6.61 on primary beneficiary? Is that, hang on. Yeah, primary beneficiary. What's the incorrect statement there?
I think it's the 4th one.
Yes.
Or the, yeah,
Oh,
the
yes,
no ability to make decisions about the entities.
right, because if you're going to be a primary beneficiary, you have to have the power to direct the most significant economic performance activities, okay?
Mhm.
And then the primary beneficiary is going to absorb, what do we call it? Most of the, they get most of the benefits or most of the losses. And if one, and while it would be rare where someone gets most of the benefits and someone else got most of the losses, if that was the case, who would be the primary beneficiary, Evelyn?
Would it be the non-controlling interest holders?
Well, it'd be the person who absorbs most of the losses. So most of the time, primary beneficiary is going to get most of the benefit, most of the losses.
Okay.
Together, but sometimes they're split. So in that case, it's who absorbs the majority of the losses comes first. All right. Or it might be the case if there was no one that got all the majority of the benefits. You know, maybe there's 3 entities that get 33% of the benefits, but one person gets 50% of the losses. So you go for the loss first. But you are correct. So that's what you need to know about sort of primary beneficiary. We'll stay with you, Evelyn, because just to get through chapter 6. What are the 2 consolidation models we discussed in class?
It was voting
interest, the voting interest model, and then the variable interest entity.
That is correct. Oh, we have one more 6. Well, we'll go to Cal, 662 Cal.
The last one is not right. A variable interest entity cannot take the legal form of a partnership or corporation.
Right. Yeah, that's true. That is, it can take that form. In fact, it often would take the form of a corporation. VIEs don't need a voting stock. We've talked about that. Low cost financing. We use these, securitization example in class, selling receivables. They're established for valid business purposes, and they generally don't have independent management. They're just a shell, sort of not quite a shell company because there's stuff in them. Caroline, number 8.
I said for part A, average rate,
That's right.
and then for part B, I said historical rate.
Right. And then how about the second question here, just to finish it off?
Let me read it quick.
I don't even need the justification.
I said current rate.
Yeah, that's the current rate. The current rate being sort of like the spot rate at the end of, if it was the end of the year at 12/31, for example.
Yeah.
And I mean, if I'm not going to ask you a question about the justification, but I mean, that's probably the most relevant, gives you the best indication of the value of the assets and liabilities of the sub, when you translate at the current rate. All right, let's see. And we'll go to Brendan Linehan, 801.
I said translation refers to the procedure required to identify a company's functional currency.
I
think.
I would say that is not the best answer there.
So I thought translation was like to prepare financial statements,
Right.
but I don't really see.
A procedure to prepare foreign subs.
Oh, yeah, okay,
Yeah.
okay.
Okay.
So it's that one then?
That's the answer, right?
Got it, thank you.
And then when I contrast that to remeasurement, you remember what remeasurement was? I know that's the question isn't here, but
So that's like trying to update like the value of what it's worth is kind of how I interpreted it.
sort of. That's when you have a foreign currency transaction, like you have receivable in foreign currency and you have to mark it to its current value. That throws off a gain, or P&L gain or loss. Does translation itself throw off a gain or loss?
Don't believe so.
Right.
So translation is more just like preparing the
Right.
financial statements.
And
So
you're
you have
correct.
a-
But these, go ahead, keep going. I'm sorry.
Wait, so that's, when you have translation is when you have like a CTA, right?
Right. And where does CTA
Okay.
go?
On the equity section of the balance sheet, because it's kind of like the other item that you kind of fill in the blank to make
Right.
the balance sheet balance.
Right. Right. Okay. Very good. Thank you. Let's see. Who is next? Ashley, 803.
I got the current rate method.
Right, that's true. That's too easy, just let you go with one question though. So do 805 also.
For the next one, I got a component of cash flows from financing activities and a consolidated
The
statement of cash flows.
translation adjustment. So I don't think that's right. So yeah, I don't think that's the best answer there. The actually, Brendan Linehan just said it. So if you can remember what he just said. So if you got translation adjustment, which is, I call it CTA, cumulative translation adjustment. That goes to where? I'll let Maggie help you. So we know it's not cash flows.
Which one did you, is it the balance sheet? Doesn't it go to, oh wait, no. The income statement, right?
Nope, but we're narrowing it down though.
Is it an element of notes which accompany the consolidated financial statements?
Nope. But the answer is here.
Are we talking about the current rate? Is that what we're talking about? Or
No,
the-
when using the current rate method, the translation
Oh.
adjustment resulting from translation, should be shown as a component of stockholders' equity, okay? So CTA goes, the difference between that when they don't balance the income statement, the balance sheet, because it's not a perfect arbitrage, you have that little difference. That's called cumulative translation adjustment. That is a component of stockholders' equity, okay?
Which answer is that?
So that is C. If there is a C. C. So I see, I can see that it says the answer. I think they gave you I think they had the wrong answer. That's probably why you chose that, yeah. So, but that still is a component of equity, the current translation adjustment. So I can see the wrong answer was bolded there, okay? But that doesn't change the correct answer. So I'll have to see what that is. But CTA goes to equity. And in fact, the effect of the only thing that's on the cash flow statement, is the effect of foreign exchange rate changes on cash. You might remember that, and that doesn't even go in financing. That goes way down the bottom, as you're reconciling beginning cash to ending cash. So that's a little error in the answers in the book. I'll have to begin to fix that. All right, Maggie, 812.
All assets and liabilities.
Right. $8.15. Let's see. I'll stay with you, Maggie. 8:15. What do you think?
Bloated financial was the US dollar. Most of the subsidiary sales work with companies in the US.
Right. So they're doing right, because they're carrying out most of their operations in this case in the US dollar, right? And that's would be a big indicator. Not the only indicator, but a big indicator of the functional currency. It doesn't really matter what on B, it doesn't matter what the functional currency of the parent is. Doesn't matter that there's other subsidiaries that had dollars that functional currency. It doesn't matter. The GAAP doesn't say that fourth one, and it doesn't matter that Diddy itself is located in the US. So it's the fact that what's the predominant currency that it transacts most of its business in. All right, Evelyn, 826.
I think it's the fourth one. There is a negative translation adjustment.
Right, that would be correct. So,
Okay.
because we're just translating, there's going to be this isn't so first of all, we're translating. We're not talking, it doesn't say we have any foreign currency transactions, right? And those would be something that throws off a loss or a gain. So we don't have to worry about that, okay? If the foreign currency moves in one direction or the other, there's definitely going to be a translation adjustment. So that throws out the first one. So now is it negative translation adjustment or positive? Well, because the value of the foreign, the foreign sub were in a net asset position. It says they have a net asset, and so when we translate that, that's going to become worth less money if the foreign currency depreciates, and that's going to throw off a negative translation adjustment. Evelyn, I see a typo. This should say under what circumstances would a company use the temporal method to translate its financial statements? When would we use that?
Was that the one where you said it was the hyperinflation, I think?
Yeah, that would be one of them. That'd be the main one. But there's one more. Anybody? Brendan Linehan,
Subsidiary uses the US dollar.
right, that'd be the other one. And again, I'm not gonna, I'm not testing you on how to apply the temporal method. But I just want you to know what it is. Oh, the other thing I should say is, oh, someone's chatting with me. Hold on a second here. Let's see what it is. Oh, okay, so we're gonna lose someone. Well, I have lost someone. Is some of these, so I might be testing like more concepts than, you know, than long drawn out accounting problems. And the reason, just so you know, the reason I'm doing that is, and there's some calculations, you can see that, but I'm probably more concept oriented. The reason I'm doing that is, in practice, it's more important not to miss the concept, right? So you have, where you really get in trouble is you don't even realize something is an accounting issue. Once you figure out it's an accounting issue, you can go back to the books and sort of figure it out. But if you miss that it's even, that you have to deal with it at all, you can't get it right. So, and there's a lot of concepts in foreign currency and business combinations, and a lot of, in these particular chapters, there's a lot of different concepts. So I'm trying to drill those into you, and you know, those would be valuable. You know, if I had if I had more than one semester where I didn't have to cover all these topics, I could, you know, go even more in depth. But that, you have to say, why is he? If you like long drawn out problems, and I'm not giving them to you. That's the reason. So you probably have a few more multiple choice, and even the ones that you have to do some of the work on, you know, they're not long drawn out full consolidations or anything like that. That takes forever. So that's it. When I've gotten in trouble, it's because I didn't in my career, it's because I didn't realize that I had come across an issue, right? So. All right, so now so we were with Evelyn. Cal, what's the difference? So I think I already answered this one with Brendan Linehan. What's the difference between, but I'll let you answer it again, Cal. What's the difference between translation and remeasurement?
So translation is when you're consolidating financial statements and the subsidiary
Yep.
is you know, in a foreign country and uses a foreign currency for its functional currency. Remeasurement is when you're taking like transactions that have exchange risk and then converting them into the reporting currency of the owner owning company.
Yeah, so that's a good, right. So that's a very good explanation. I would just add on to the remeasurement a little bit. That's like Cal said, it's something we have foreign currency exchange risk. That means you have two companies that have different functional currencies, and you have to transact in one of them. So one of those companies has foreign, whatever the transaction is denominated in, the person that has a functional currency other than the currency that's denominated in, they have foreign currency exchange risk. And like we did that with receivables and loans, you have to remeasure that each period, and that throws off foreign exchange gains and losses. All right. Now we are on to Brendan, 870 here. All right, so this is a big one here. Let's see. What am I doing?
It's 8,550, and you get that by multiplying the 9,000 times the average rate, because it's you multiply because the average rate, because it's like an expense over the period of the year. So you use the average rate because you don't really know exactly when it's from, right?
Right. Well, right, usually right, because it's occurring ratably. So that is right. So we gave you all this information to throw you off, but you cut right through it and got to what's important. And that's what your clients will do. They won't literally give you a bag. I call it like they're gonna give you this big bag full of information. You know, tell me what's your answer? You know, so you're gonna go through that, all the information they give you, try to figure out what's relevant, what's not relevant, which to not even look at, and then what information is missing, if any. So you got the right answer there quickly. All right. So we're back to Ashley on 701. We're on to chapter 7.
Okay, I got a $4,400 loss.
That's correct. How'd you get it?
So I took the 40,000 of the British pounds and I multiplied it by 1.56, which was the original exchange rate.
Yeah,
And then I took the 40,000 and multiplied it by 1.45, which was the exchange rate on May 8th.
Yep.
And then I subtract from the first one, I got 62,400.
mhm,
And then I subtracted out 58,000 from that.
yep,
And since it decreased in value, it was a loss.
there you go. Excellent explanation, crystal clear. I'm not even gonna write that down. I'll stay with Ashley because the next one's easy.
I got the price of foreign currency can be purchased or sold today.
Right, that's correct. The other ones in the future, that'd be a future rate, which we didn't cover in class. The forecasted future value of foreign currency, nope, we don't use that. The euro value of foreign currency, that just makes 0 sense at all. How about the last answer? The amount your dog spot would be saleable for in a foreign currency. I added that one in myself, so that wasn't actually in the book. So made me laugh. Anyways, spot rate, get it? It was a comedian, Stephen Wright, great comedian, still alive. He was a deadpan comedian. One of his jokes was, I spilled spot remover on my dog, and now I can't find him. So that's funny. But we'll move on with accounting. I'll stick with accounting. 723, we'll go to Maggie.
I got no foreign exchange gain or loss will result
And why is that?
because it's the foreign company is operating in US dollars, so there's
Right,
no need to
that
translate
is
it.
right. You are correct, and your rationale is correct. All right, let's see. We go to Evelyn on 738.
It's a $6,000 loss because it's the total, it's the number from April 1st, then you subtract. So you start with the April 1st, 2020 number, then subtract the April 2021 number, and you get that $6,000 loss.
Right, so let's see about. You're right. I'm just trying to catch up. And your answer is right. I'm just trying to. Because we buy, and it's a loss because, well, first it's a foreign currency transaction, right? Because it's a US company borrowed euros. So it's denominated in euros. Right. And so initially we owed them 97,000. Now we owe them 103,000 the way it moved. And that's a $6,000 loss.
Can I ask a question on that one?
Yeah, yeah.
So why do you use the, so it says, wait, how much foreign exchange gain or loss should be included in 2020's income statement? Why do you use the December 31st, 2020? Is it because you're looking at the end of the year and then subtracting what it was as of April 1st?
That's right. Well, right. So that's the end of the year value. And we're trying to figure out what goes into 2020. And they're using the April 1 date because that's when the loan was signed.
Okay,
Right. So you see that April 1. So there's 9 months of risk here from April. It was signed April 1. And they want you to know what the gain or loss at the 2020. It doesn't say it's a calendar year company, but that would be the assumption here. Okay.
okay.
You see that?
Mhm.
And so initially we put it on the books at 97,000 liability. And when we have to increase that at the end of the year, we got to increase the liability. So we're going to credit the liability 6,000 and debits to a loss. All right, well, I have you, Maggie. So on the next question,
You remeasure first and then you translate it?
right, that's correct. Because, and the reason is, you have to, in order to prepare your financial statements for translation, you have to do the accounting first. Remeasurement is just the basic accounting to get your financial statements right, even if you're not going to translate them. So you would always do that first before you translate it.
Can I ask another question on that?
Yeah, sure, yeah.
So I know like translation relates to the like the current method, right? And the remeasurement is used for the temporal method. So in this question, do you always like remeasure and then translate, or do you only do that if you have to do like, do you know what I mean? Do do both of them when
Well,
you're,
yeah, that's, yeah, you would remeasure, well, the temporal method, if you were, well, maybe if the dollar was this functional currency, I think generally, so if it's hyperinflation, but if you had foreign currency transaction adjustments, in both those cases, you would remeasure first before you translate. So if it was the, if you, the dollar, US dollar was your foreign currency, you'd be remeasuring, yeah, you'd be remeasuring, but there'd be no translation because you're remeasuring into the US dollar. When you use the temporal method, all the remeasurement is, throws off gains and losses, right? So when you have to do both, you'd remeasure first, then do translation. So I'm not sure if I answered your question.
okay, yeah, that makes sense.
Okay. All right, so 828. And 830. So what I do? 428. Just scan these. All right, if you want to hang on, I can go scan these and get these into the computer. It'll take me a few minutes to do these two problems, and I'm happy to go over them with you if you're so inclined to wait. Well, first, before I do that, and those two problems, the ones we skipped earlier in this 831. I don't, if you guys, did you guys do those? Can't hear you, Maggie.
Yeah, I had trouble with the first one for chapter 4. Is
Uh-huh.
that kind of like, you said it's 3 problems. Are the test like problems gonna be more like those 2 solutions or kind of like the math ones that we've been going over?
I can't remember. If I could, I'm not sure I would answer, but
Yeah,
the real answer is I can't remember.
I know, worth asking.
Yeah, but I think this is a good blueprint for the exam, so at least all the concepts. And I can assure you, there's gonna be a couple questions that for people going over there's a couple bonus questions. There'll be something that looks maybe exactly similar, not too many, but like something, a payoff for doing this. And because the goal isn't to try to stump you, the goal is to teach you. So if you spend all the time going through this practice exam and really learn this stuff, good for you. I hope we all get A's, honest to God. I know you probably don't, I'm sure you believe me, but I would have no trouble handing out 10 A's. I've never been able to do that yet, but it's not because I wouldn't love that. So let me go and try to, I got a copy and another printer, and I'll come back and scan, and then it'll take me just a few minutes, okay? Okay, I'm just gonna scan these. Be just a second now here. Let's see, hang on, it's scanning to me right now. Emailing. All right. All right, so here's 28. So let's all take a look at it. Did anyone do this correctly? All right, let's see. Let me look at it. 6% outstanding stuff. So we sort of did this. I mean, we sort of did these concepts already today. Let's do them again. So if I buy the so if I buy 60% of the outstanding stocks for 36,000, then how much is the whole thing worth?
Wouldn't it be 60,000?
Right, I think it would be 60,000. So I'm just gonna, so they give me that info. I'm just figuring it out along with you guys. So total fair value. $60,000, this is how I would do it. And that's controlling, I do the controlling piece. Is 36, right? And then non-controlling NCI is 24. I'm just gonna put those numbers, see if we need them. All right. As one asset, a specialized production machine with book value 10,000, no liabilities. The fair value of the machine, so there's a $40,000 step up. Sorry, book value. This is gonna be $50,000 step up all 40,000. The 50 minus 10, so the step I'll just put that down here. So I got a machine step up. I'm just gonna start with 40, but that's the see, they said it was worth 50 and it was book value was 10, so it was 40. So the useful life is how many years? 10. So that's amortization for a year, right? To controlling is 3.2. And non-controlling is 0.8, right? Let's see if I get that
Wait, how
right.
did you get that?
Well, the step up is 40,000. You see that? Oh,
Yeah,
no, I did it wrong. I did 80%. You're right. So controlling is 2.4. And non-controlling is 1.6. I went back to 80%. That's 60%. Okay, so I did the machine step up is 40,000. That's the difference between the fair value of 50 and the 10. Okay. And we're gonna have to do, we'll have to record the excess amortization, right? And only the excess because the subs books are gonna continue to depreciate the 10, right? But in consolidation, we gotta amortize the 40. It's got a useful life for 10 years. It gives total amortization of 4 for the entire company. 2.4, 60% of that 2.4 will go to the controlling interest and 1.6 will be the non-controlling interest. Everyone got that? And then they're saying the rest of the value, which is going to be 10, right? Because it's the 10 plus the 40. This machine's worth 50. The whole fair value is worth 60. So the other 10 is for this trade secret. I'll put that over here. Where'd it go? Why isn't it over there? Ten has a life of 4 years. So that's amort, is this is on a per year basis is 2.5. And then we split that between controlling. So that's 60% of that. What's that? 1.5. And NCI is 1. All right. So, and then I've got, so we'll do the net income first. We'll do, so we got 30,000, we start with there. All right, so what I would do is, so then they give us net income. I'm gonna do the net income. So net income's 30,000. This is, before the step up. But my step up though, expenses are we're doing for non-controlling. So the NCI piece of that is 12, right? 40%. Then I need the NC less less 1.6 and then the 1.0 over here. Because that's non-controlling NCI machine. that's the step up, that's 1.6. And NCI trade secret. 1.0. And that should add up to 9.4. All right, so you see that? Any questions on that? So first I wrote down all the information they gave me. Well, I don't know if I'm gonna need it all or not. I took the total, I figured out the beginning controlling interest. I figured out the fair value of the whole thing. I bought 60% for 36,000. I'll go over this part faster. I bought 60% for 36,000. That gave me total fair value for 60. 36 pertain to the controlling interest and 24 pertain to the non-controlling interest. Look, I think I'll need that later. Then they gave me that I had fair value step-ups. For machine, the step-up was 40, the difference between 50 fair value and 10. I had a useful life for 10 years. That's amortization of 4 per year. I allocated that on an annual basis between the controlling interest to 60% and non-controlling interest to 40%. I did the same with the trade secret over here, okay? Then I found out then the first thing I chose to figure out is the non-controlling interest in the subsidiary income. So the subsidiary income they gave us was the 30, right? I know, well, that's the whole subsidiary. The non-controlling gets 12 of that, right? 40% of that. But then they also have to take their share of step-up expenses, which we calculated 1.6 and 1.0, and that gets you the 9.4, and that's the answer for the. I think that's the answer that's in solution, right? Like I'm looking at the solution. That's not how they did it. I think what I'm doing is a little clearer than how they did it. Okay, to me. So you got that. So now non-controlling interest. All right. So I would say the beginning non-controlling. I think probably gonna have to do a beginning non-controlling interest plus income less dividends should give us ending non-controlling interest, right? The roll forward. So let's see if I'm doing that right. So beginning NCI, what's that, 24? That's from over here. Plus the net income pertain to a NC non-controlling interest income. Of 9.4. And then what do I do with the dividends? Then they said they declared dividends of 5,000. How much of those go to NCI?
2,000.
Yeah, 40% of that, right? So that's 2. So ending NCI. What's that add up to? 31.4. Yeah, right. Yes, and that's the answer. Okay. And then, and then they trick you a little bit. Okay, so now we've done the subsidiary income and the controlling interest. Now the machine's value. So someone to help me out here. This is a little trickier. So there's 2 pieces to determine the machine value. There's the book value, and then there's a step-up value. Okay. So the book value is going to. They say that has a 10-year life left. So how much depreciation is the subsidiary going to record before the step-up? Cal?
400.
In 1 year, see, the book value is 10,000 with a life of, there's two pieces to the value of this machine. There's the book value of 10,000 that depreciates, that'll get normal accounting on the subsidiary's books. And then there's the step up of 40,000 that we have to record depreciation for in consolidation. So in 1 year, at the subsidiary level, based on the book value, how much depreciation will be taken, Cal?
Well, it'd be 1,000 for the entire year, right?
Yes, 1,000, yeah. So the book value, so the depreciation, they want us to find the value. So it was 50, all right? Let's see, so we'll do that. So we'll do the stepped up value of the machine is 50. And at the end of the year, we'll take, I'll call it subsidiary book value depreciation. This look, they take 1,000. And then how much do we take? Then how much do we take in consolidation for the step up, Cal?
4,000.
Right, 4,000. Then I'll call it step up amortization or depreciation. And that's 45,000. So that's the value of the book, the machine at the end of the year. That's how you get it. And on the trade secret, did it have any beginning book value?
Wasn't it unrecorded?
It was unrecorded. So then, therefore, we don't have to worry about depreciation, amortization that's happening at the subsidiary. The only thing that's happening is the amortization in consolidation. And so how much is the trade secret getting amortized in consolidation, Brennan? It's on this page somewhere.
10.
Yeah, that's the value of it. It's got a useful life of 4 years,
Oh, so 2.5 per year.
2.5 per year.
Okay, yeah.
And so it was at 10 at the beginning of the year, less 2.5 depreciation. So the net value of that trade secret is 7.5.
Yep.
All right. All right, so that's how you do. So that's the answer to that. Everyone got that? I think the trickiest piece was determining the value of the machine, in my opinion, because you had to remember to consider the depreciation of the book value and the depreciation of the step up. All right, let's see. $31. I gotta read this. Yeah. I'm not gonna do this. I'll tell you, I'm gonna give you a hint. You will not have to calculate the translation adjustment on this exam. So therefore, we did this in class. We did this one problem in class already, right? It may not have been this one, but I think I'll skip this for the purpose of this test. But that doesn't mean I have to go. Any other questions or concepts I can help you cats with before you guys go shower and get all pretty for the black and white ball?
I think I'm good right now. So it's just, the test is on chapter 4, 6, which is just the VIE and voting interest. And then 7 and 8, not including hedging, right?
Right. 7 is just foreign
Okay.
currency transactions.
Okay.
And
We read that
in
there.
8, it's all of 8, but I'm not going to test you on how to apply the temporal method. You have to know what it is when it's applicable, but not how to do the math on it.
Okay.
And
Thank
then and on 6, it's just the key concepts of variable interest entity. What is it? What's a primary beneficiary? What are the key terms we've covered? Whatever it is. So
Okay, and then the primary beneficiary is the person who has, it's primarily who has the most risk, but it's also who gets the most benefit, but risk is like the tiebreaker essentially.
Yeah. And then if you're the primary beneficiary, what's that mean? For county
That means,
purposes?
you're responsible, you're responsible to have all the losses, right? Like you're at risk if something goes wrong.
That's true, but it means you're the person that consolidates it, right?
Oh, okay, yeah. I feel better.
Anybody else?
So I have just a general question. So
Sure.
everything that we did in chapter 7, right?
Yeah.
Is that all just remeasurement? Or
Yeah,
not?
yeah,
Okay, so that would all be considered remeasurement. That would be in other comprehensive income. And then chapter 8, all that stuff, or not all of it, but the current rate stuff, that's all translation adjustment.
you're right on chapter 8, but chapter 7 is gains and losses that go in the P and L.
Sorry.
Yeah.
Yeah. You know,
Right, you got that? So when you mark the foreign currency, receivable, payable, whatever it is to the current spot rate, that resulting thing is a foreign currency transaction gain or loss that goes in the P and L.
okay, so what goes in the comprehensive income is when you're doing the temporal method of remeasurement or remeasuring.
No, I
the-
think what goes into comprehensive income, which I'm not going to talk about comprehensive income too much. I haven't talked about it too much in this class, but OCI, I mean, the CTA is a component of, well, it goes in equity, it goes as a component of comprehensive income too. But which is other than net income. But I'm not focused on comprehensive income in this class. Did you guys discuss comprehensive income in intermediate?
Yeah, a little bit.
Yeah. CTA will go in there, the changes in CTA, but I'm not going to ask anything about comprehensive income.
Okay, thanks. I just got that a bit confused. Thank you.
Now net income, of course, is a component of comprehensive income, right? There's some other items in there too. All right, that's good. Those are good questions. What else? Evelyn, any other parting shots for me, Evelyn?
Not that I can think of right now.
Is this helpful?
Yes, definitely.
Okay. Okay, I'll put this up on, I'll put this up on YouTube and send a link out so you guys, if you didn't have enough of me today, you can, let's say you get bored of the black and white tonight, Brendan, I'm gonna go watch my review accounting session with Professor J Mac,
That is a very tempting offer. I may have to
Yeah,
do that
yeah.
later if it's a little boring.
Yeah. I should have let you wear my costume. I just don't think it would fit you. Yeah.
That would have, but if I broke that or something went wrong, it would have felt terrible. That would have been an absolute hit though.
Oh, I can assure you it's a hit everywhere. Yeah. All right.
Maybe I'll have to get a matching one.
Yeah. All right, everybody. Anything last for me? See you Monday morning. Have a
Thank you.
great-
Thank you.
Whoever's no matter what anyone's doing, like all the black and white or doing something else, have a great rest of the weekend.
Thank you as well. Oh, I
Thank you.
forgot to say, we have registration Monday at 7:30, so I don't think anyone's gonna be able to take it early.
Oh,
So I think people will be there at like 8.
okay.
Just so if you get there at 7:30 and no one's there, I think we have registration. at
Okay,
that
that's
time.
a good heads up. I will be there at 7:30.
Okay.
And whoever, I didn't know that. Okay, well, hopefully that gives everyone enough time. I can stay after. We might have to move out in the lobby, if there's people that aren't done, so. But I don't think that'll be the case. All right.
Yeah. All
Thanks for
right.
the heads up. Take care,
No
everybody.
problem. Thank you. Bye-bye.
Thank
Thank
you.
you.